tariffs, they can sound like pretty dry economic policy, can't they?
Yeah, definitely. Abstract.
But lately, it feels like their reach is just expanding, touching, well, almost everything from the price of stuff we buy to even international travel.
It does feel that way.
Okay, so let's unpack this. What are the immediate, like, real-world consequences hitting us, consumers and businesses because of these recent trade changes?
That's exactly what we're diving into today. We're looking at a pretty fresh analysis, actually. It's from Apollo Global Management, dated April 2025.
Okay, so very recent.
Very recent. And they've taken a really close look at how these recently implemented tariffs are impacting U.S. consumers and firms, like right now.
Oh,
Think of this as a snapshot, the initial ripples caused by these shifts in trade policy.
gotcha. So this isn't just theory then. This is based on what was actually happening just last month. Real data, market observations, and it sounds like some really telling anecdotes too.
Exactly. On-the-ground accounts, data points, sentiment indices, works.
And our mission here really is to cut through the noise, right? And identify the core insights. What are the tangible effects we're already seeing?
Precisely. It's about understanding how people, individuals, and companies are actually changing their behavior, changing their expectations as a direct result of these new trade policies.
Okay, let's kick things off with how we as consumers are reacting. And from what I'm seeing in this analysis, the picture isn't exactly rosy. Consumer confidence.
hmm
It's reportedly scraping record lows across the board.
Yeah, it's pretty stark. And what's fascinating, or maybe worrying, is how widespread this feeling is. Apollo's analysis specifically points out that this isn't limited to one income group.
Oh, really?
Yeah, families earning both above and below $100,000 per year are showing this, well, significant dip in confidence,
Wow.
which suggests a really broad concern about where the economy might be headed.
Yeah, that makes sense. It's not just one group feeling the pinch.
And this isn't just about feeling down, right? It directly translates, potentially, into reduced spending power and just a more cautious approach overall for everyone.
It also sounds like some people maybe saw this coming, saw the writing on the wall, and tried to get ahead of potential price hikes. We're hearing about this idea of front-loading purchases.
That's right. So front-loading, it simply means buying things sooner than you might actually need them.
Right. Trying to beat the price increase.
Exactly. Hoping to beat any price hikes caused by the tariffs. The idea is that some consumers, anticipating these increases, well, they made purchases earlier than they normally would have.
Pulling demand forward.
Brute forward demand, essentially. Of course, this could lead to like a temporary bump in spending,
Mm-hmm.
followed by a potential slowdown later as those needs are already met. You bought the washing machine early, you don't need one next month.
Right. Right. Makes sense. And it's not just about buying, physical stuff. It seems even our leisure activities are being affected. Tourism is apparently taking a hit.
Yes, and the data here highlights a really notable decline, specifically in international tourism.
Okay.
The report mentions a significant 30% year-over-year drop in European tourists visiting the U.S.
30%. Wow.
Yeah, and an overall decrease in foreign tourist arrivals, too. We're even seeing this reflected in specific places like Las Vegas, with a decline in overall tourism and the number of hotel room nights occupied.
Mm-hmm.
So beyond just individual spending on goods, it seems these tariffs are even impacting, broader sectors like travel and hospitality.
That's a huge drop. It really underscores how interconnected everything is, the global economy. And beyond just how we're spending our money, it sounds like people are genuinely concerned about their jobs, like fundamentally.
Absolutely. The analysis really emphasizes a growing concern among consumers about job security.
Mm.
We're seeing data that reflects increasing expectations of more unemployment in the coming 12 months. And that anxiety, can significantly impact spending decisions. Makes people way more hesitant about big purchases or maybe even just everyday expenses.
Yeah, you tighten the belt. And it's not just their own jobs. It seems like people have a pretty pessimistic view of the overall business climate as well.
That's another key point. The report highlights a record high share of consumers who believe business conditions are actually worsening.
Record high.
Record highs, according to this data snapshot. And this perception, whether it perfectly matches real-time data or not, it can become a bit of a self-fulfilling prophecy, can it?
Sure can. If everyone acts like things are bad.
And people and businesses become more cautious and activity slows down.
Exactly. All this worry, all this pessimism, it has to be impacting how people are managing their finances, right? Are we seeing clear signs of increased financial strain?
Yes. Several indicators seem to point that way. There's a rising share of credit card accounts where people are only making the minimum payment.
Okay, that's a classic sign.
It is. And we're also seeing increasing delinquency rates on those cards, too.
Not good.
Not good at all. These are really classic signs of consumers feeling squeezed financially, having less wiggle room in their budgets. It's a worrying picture when you hear about more people struggling with credit card debt, something many of us can probably relate to on some level, unfortunately.
Yeah, definitely. And we're even getting some like real world examples of this, like what the CEO of Chipotle is observing.
Yeah, that was an interesting anecdote in the analysis. And what's telling there is that the overwhelming reason Chipotle's CEO cited for people visiting less often was consumers actively saving money because of economic concerns.
Just straight up saving money.
Straight up.
Yeah.
It's a direct link, seemingly, between these economic anxieties, which are potentially fueled by tariffs and their impact on prices, and actual changes in everyday spending habits, like grabbing lunch out.
And it's not just fast casual. Even major players like PepsiCo, their CFO is apparently expressing less optimism about the consumer than they were just, what, 3 months prior?
That's right. And that broader sentiment from a huge consumer goods company like PepsiCo, well, it really underscores the shift in the landscape.
Yeah.
It suggests these concerns aren't isolated to specific sectors, like restaurants, but are being felt much more broadly across the consumer economy.
Okay, one last point on the consumer side here. We're seeing a decline in cash purchases of homes. What can we infer from that?
Well, a decrease in all-cash home purchases can indicate a few things. Mainly, a tightening of available cash, maybe less confidence,
Right.
and potentially just increased caution in making really large investments, like buying a house.
Especially without financing.
Exactly. It suggests that even those who might have had significant cash reserves are becoming more hesitant about deploying them in the housing market, perhaps anticipating, further economic uncertainty down the road.
Okay. So when we look at consumers, it's a pretty consistent story, isn't it? Declining confidence, pulling back on spending, growing financial worries, all seemingly connected, at least in part, to these tariffs, according to this Apollo analysis from April.
Seems to be the picture, yes.
Now let's turn our attention to businesses. How are firms navigating this new trade environment? It sounds like they're facing some pretty significant challenges as well.
Indeed. One of the most immediate reactions from the corporate side is really rapid downward revision of their expectations for future earnings.
Okay, looking ahead, they're less optimistic.
Much less.
Hmm.
The analysis points out that this is actually the sharpest decline in the earnings outlook since 2020.
Wow, since the pandemic hit.
Exactly, which is a pretty significant red flag, indicating real concern about future profitability.
Yeah.
And this pessimistic outlook, it's already manifesting in concrete business decisions, like the slowdown in new orders we're observing.
Okay, so what's fueling that pessimism among businesses, beyond just the general mood?
Well, several factors seem to be at play, according to the analysis. We're seeing new orders falling. They were actually already in contraction territory back in March, with expectations for a further dip in April. And at the same time, corporate CapEx, their plans for spending on things like new equipment, buildings, infrastructure.
Big investments.
Yeah, big investments. Those plans are showing a sharp reversal. Businesses are just becoming less willing to invest in future growth when the demand outlook is so uncertain.
Which kind of makes sense, right? If they're not expecting as much demand, maybe partly because of these tariffs impacting consumers.
Exactly.
It creates this sort of negative feedback loop where reduced investment could then further hinder growth down the line.
Precisely. And on top of potentially lower sales, it sounds like businesses are also dealing with increasing cost pressures. Is that right?
But that seems to be part of it, too.
Yes. The prices that businesses are paying for their raw materials, other inputs, they are rising. That adds pressure on their profit margins.
A direct hit from tariffs on imports.
That seems to be a major driver. Tariffs make imported goods more expensive, which then gets passed down the supply chain, hitting businesses' bottom lines.
Okay. And what about inventories? I saw a mention of a rise in stockpiles before the tariffs hit.
Yeah, there was apparently a rapid buildup of inventories before the tariffs fully took effect.
Like the consumer front-loading, but for businesses?
Kinda, yeah. It could be firms trying to stock up on goods before the tariffs made them more expensive. A similar strategy. However, if demand subsequently weakens, as the consumer data suggests it might be, then these high inventory levels could suddenly become a liability. Stuck with stock they can't sell easily, rather than an asset.
Right, dead weight on the balance sheet. We're even seeing the impact ripple through specific industries like trucking.
Yes, the analysis highlights a significant drop in truck sales in March. That's a really telling real-world indicator.
Why trucking specifically?
Well, fewer trucks being sold usually means businesses anticipate moving less freight. Less freight needs to be moved if fewer goods are being bought and sold overall.
Okay, so it's a proxy for general business activity.
A pretty good one, yeah.
Yeah.
The slump in truck sales is a stark indicator. Fewer trucks moving means fewer goods being exchanged, signaling a pretty fundamental slowdown in economic activity, not just like a sector-specific issue.
And this ties into something the report calls the Voluntary Trade Reset Recession. That sounds ominous.
It does. The analysts are calling this a voluntary trade reset recession, which essentially means they see an economic downturn being triggered by a deliberate pullback in trade activity,
Hmm.
due to these tariffs rather than just a natural cyclical downturn.
Okay, let's maybe delve into that timeline they sketched out for this voluntary trade reset recession. It sounds quite concerning.
Yeah, the analysis lays out a potential sequence of events based on the data they were seeing in April. It begins with container departures from China to the U.S. slowing down rapidly in early April,
Okay, which they are already observing.
which they were already observing, yes.
Yeah.
Now, based on the typical, say, 20 to 40-day transit time across the Pacific, they anticipate container ship arrivals to U.S. ports potentially coming to a halt in early to mid-May.
A halt. Wow.
That's the projection. Following that, given the much shorter, 1 to 10-day transit time for trucks moving goods from ports inland,
Right.
they project trucking demand itself coming to a halt in mid to late May.
Which connects back to the truck sales drop.
Exactly.
Yeah.
And this could then lead to layoffs, they suggest, maybe in trucking and retail industries in late May or early June.
Okay.
Then potentially you see empty shelves as inventories are depleted and companies respond to lower sales, potentially culminating, they argue, in a broader economic recession in the summer of 2025.
That is quite a sobering potential outlook based on those April indicators. And
Yeah.
it's not just consumers feeling less confident. It sounds like that sentiment extends right to the top, to CEOs.
Yes, absolutely. We're seeing CEO confidence declining in surveys,
Okay.
which signals, less optimism, a more cautious approach to investment and hiring from the leadership level.
And the Logistics Managers Index,
Yeah.
also down.
This-
Also down. That index gives us a snapshot of various bits of the supply chain inventory levels, transportation costs, warehousing, and it's showing decreases in both current conditions and future expectations. So that further supports this narrative of a significant slowdown in trade and overall economic activity.
And the impact on trade itself, particularly between the U.S. and China, seems, well, quite drastic according to this.
The report really highlights what looks like a near halt of trade from China to the U.S. based on those April numbers. We're seeing those slowing container departures from China.
Right.
And as we discussed, the anticipation of container ships possibly ceasing their arrivals soon after. This disruption is also reflected in falling container freight rates.
Supply and demand. Less demand for shipping.
It means lower prices to ship things. It's a clear economic signal of reduced demand for shipping goods across the Pacific.
It's also interesting to note the significant imbalance in the U.S.-China economic relationship that the analysis points out. The fact that S&P 500 revenue from China is so much larger than U.S. exports to China. Yeah, that's a crucial point. What you need to understand there is the potential impact on the earnings of major U.S. corporations if trade with China is significantly curtailed.
Right, it hits the big companies hard.
Potentially, yes. The fact that S&P 500 companies derive roughly 6 times more revenue from operating in China than the total value of goods and services the U.S. exports to China, well, it just underscores the vulnerability of these large companies to disruptions in that specific trade relationship.
Okay, so when we piece all of this together, the consumer pullback, the business caution, the trade disruptions, what's the main takeaway about the broader economic picture as of April 2025, according to this Apollo analysis?
Well, the analysis basically concludes that a trade war, like the one unfolding, acts primarily as a stagflation shock to the economy.
Stagflation. Okay, can you break that down quickly?
Sure. Stagflation is that particularly nasty combination of slow or stagnant economic growth happening at the same time as rising inflation, rising prices.
The worst of both worlds, kind of.
Pretty much. It's really difficult to manage from a policy perspective. And they contrast this stagflation scenario with other possibilities, like, an overheating economy or a straightforward recession without inflation, or that ideal Goldilocks economy.
Not too hot, not too cold.
Right, or even just pure inflation. They argue a trade war uniquely hits both the growth side and the price side negatively.
So for you listening, what does stagflation mean in practical terms? For your wallet, your job prospects?
Well, it could mean things like slower wage growth, maybe fewer job opportunities, while the cost of everyday goods, food, gas, housing continues to rise. So your paycheck doesn't stretch as far. It makes it harder to make ends meet.
Right. It definitely paints a picture of a very delicate economic situation unfolding back in April of 2025, based on this one analysis.
Yes, based on this snapshot.
So just to quickly recap the key insights we pulled out. Consumers were feeling the pressure, cutting back spending, businesses were bracing for lower profits, scaling back investments, and the whole flow of trade, especially US-China, was facing a major disruption, all pointing towards this potential stagflationary environment.
That's a very clear and concise summary. Yeah. This analysis really highlights how interconnected everything is: consumer behavior, business activity, international trade, especially when you see these immediate reactions to big policy changes, like these tariffs.
So here's what I really want you, the listener, to consider as we wrap up. Given these very immediate and pretty substantial responses that were observed in April 2025, what are the potential longer-term structural changes we might see, in the U.S. economy, in global trade relationships, if these kinds of tariffs remain in place?
That's the big question, isn't it?
Yeah. And how might individual consumers, maybe like you, and businesses need to fundamentally rethink their strategies to navigate what could be a sustained period of this kind of economic uncertainty?
Those are absolutely critical questions that go way beyond this immediate snapshot from April. They really get into the potential lasting consequences, the ripple effects long term.
Definitely something to mull over. Thanks for taking that deep dive with us today.
My pleasure.
We'll catch you next time.